I don't know if it's just me, but I have noticed a lot more sentiment about a stock market crash. Definitely a lot more anxiety. My mom, who's in her 50s, she's kind of like, okay, what could be the tipping point? Like, here we go. It's going to happen once again. And especially for folks who've lived through the 1990s crash, the dot-com bubble, the 2008 recession, and the pandemic crash of 2020, we know what it's like, right? A lot of us have already felt this before. We have seen stocks that were trading for $110, and then in a few weeks it was trading for $11. Specifically, Amazon crashed over 90% during the 1990s dot-com bubble. Other stocks like eBay crashed about 80%. So who can actually stomach that? Not a lot of people, but those that do, well, they were greatly rewarded. But not every single stock or company actually healed. A lot of dot-com companies disappeared forever. I want to talk about this anxiety that's surrounding the stock market crash, because I'm a behavior analyst, and to me, anxiety, even though it's a feeling, it's a behavior, because ultimately anxiety comes from the thoughts that we have. And what are thoughts if not behaviors? And we can control our thoughts to a degree, the same way we can control our feelings and train our feelings, right? Of course, we have impulses. Like me, I definitely can't control panic going down wherever it's going down. I got a lot of panic happening when I imagine going back to 2020 and seeing 5 years of profit disappear in just a week when it comes to stock market returns. Literally 5 years of gains vanished in a week. Now, that's not for everyone, but it is for everyone who is growing wealth. If you are growing wealth through the stock market, you need to be comfortable experiencing your portfolio being cut in half. It will probably happen, and no one knows when it's coming. So trying to protect yourself, and we're going to talk about how to truly protect yourself, but by just selling your positions, that is not how you protect yourself. A lot of people go ahead and they sell their entire portfolio, and then they end up missing out on a 12-year bull run. And a bull run is when stocks just keep going up. Now, it doesn't happen linearly, but since about 2011, stocks have just been skyrocketing, right? We did have a couple slowdowns like in 2015 and 2018, but ultimately stocks just keep going up and up and up and up. And this isn't new. Stocks always tend to go up. If you go back to the 1800s, right, the stock market has been, increasing slowly but surely. And that slowly is relative. To some, stock market gains are actually really, really quick, especially if you compare it to bank interest that's been paid out. So what is going to trigger the next stock market drop? Well, let's go back to 2008. When a ship is sinking and it goes to the bottom, right? It sucks in everything around it. So if there's little ships, little dolphins, whatever, they are going to get sunk down. But when it comes to stocks, a lot of companies that have nothing really to do in they shouldn't be impacted as a company by a stock market crash or some economic reason, a variable, right? Like when Lehman Brothers in 2008 crashed, they sunk all these different companies down with them. So a lot of those companies obviously recovered within about 2 years or so, if not beyond that. If we look at the pandemic crash, what makes sense is for REITs, right, real estate investment trusts, to crash down, because real estate, like, who cares about real estate when everyone's just working from home? You're not going to rent out office spaces or even need to be upkeeping all of that. So it does make sense that the real estate part of the economy basically collapsed. Sure, that makes total sense. Even though when it comes to housing prices, they've remained the same. But REITs, they zoned in on the actual issue of we're not going to offices to work anymore. But what else crashed? A bunch of companies that had not much to do with the pandemic, especially companies like Square, right? What business, no pun intended, did Square have dropping all the way from $100 per share to $30 per share? Had no business dropping. And once people caught on, hold on, Square is actually one of those companies that should be doing well during a pandemic, because, people are using cash less and they're doing non-touchable, just using their cards and scanning their information that way to get, whatever they get, I guess, when people buy things. But Square has blossomed as a business, and its stock price has skyrocketed from $30 all the way to $200. So yes, a sinking ship may take down everything nearby with it, but eventually things that were not meant to sink do float up to the top, and some begin to levitate. So when you do see your positions crashing, perhaps the next sinking ship will be what's it called? Let me check right here. Everglade, right? Everglade, one of the biggest Chinese companies that has to do with real estate, is going through some financial hardships right now. And just a reminder, 29% of Chinese revenue is coming from real estate. So this is huge that their number one real estate company is going through a financial hurdle. And if it goes under, I do suspect and predict, and I'm not alone here, that a lot of other companies are going to go down with it, and then they're going to float to the top. But a giant crash in China can definitely impact U.S. portfolios in Europe, because everything is connected. And if you know me, if you've been following me on Instagram, I have actually invested in a Chinese company, Alibaba. So I'm actually pretty bullish on China performing well, but I am predicting that there might be some sort of crash that could come out of China in the next few months. Now, no one knows for sure. If you see like people saying, hey, in October, there's going to be a giant market crash, you better sell everything now and then buy back in October. Nobody knows. No one knows. And if there is a stock market crash in October, it's not because the Illuminati told me or anything like that. No, in all seriousness, no one knows when the stock market crash is coming. But we do know that it is coming. It's not an if the market crashes, it's a when the market crashes, because statistically the market crashes about every 10 years or so, at least once a decade. And if you live through the 1990s all the way to 2000 and early 2020s, we're still in the early 2020s, right? Yeah, okay. I time traveled back to the right spot in history. I should delete this part. YouTube is definitely going to send their time travel goons after me. But anyways, how do you protect yourself and your portfolio if you know that a stock market crash is likely to happen within the next 5 years? Well, you want to have uncorrelated assets. And what does that mean? Stocks that are not just stocks, actually, anything that could go up in value over time, whether it's slowly or quickly, but it is not correlated with the stock market. So if there is some sort of news like Joe Biden and capital gains capital gains taxes increasing, which, by the way, the proposed tax is off topic, but they're probably not going to impact anyone except for people who are actually making more than $400,000 a year. So most people watching this do not have to really think about how these taxes are going to impact them. But it is always fun to, brainstorm and break it down. But off topic. But those types of news can spike like uncertainty in investors and lead to a tipping point where just a large enough minority of investors start selling their stocks, leading to an avalanche effect. An avalanche effect is more likely to happen when stocks are near all-time highs, because no one wants to buy stocks when they're at all-time highs, and that's how actually a lot of investors end up losing, because when a stock market hits all-time high, it is more likely that it'll hit another all-time high during that same week. It might happen 2, 3, 4 more times. So when stocks are at all-time highs, they're more likely to keep on being at all-time highs. Just like if the weather is rainy and you're driving in LA, one car accident will likely lead to another car accident. So having a lot of car accidents leads to a lot of car accidents. Just the same way that stock market being at an all-time high leads to the stock market being at an all-time high. Now, when there's a drop, the drop usually creates this avalanche effect, and we can have 10% wipeouts in one day. But besides yourself protecting you from your portfolio, there are institutional assists plugged into the system. For example, circuit breakers. Circuit breakers will go off if the stock market drops 7%. Boom! You cannot trade stocks anymore for 15 minutes. The next one will come in at a 13% crash, and then it'll come in again if the stocks drop more than 20%. So if stocks drop more than 20%, that's it. You cannot trade for the rest of the day. I have never witnessed this personally, but I have seen the 10% one circuit breaker get hit back in March of 2020 when we did have a single day, I believe, stocks went down 10% in a single day, like hopping around, minus 15%, minus 10%, minus 7%, right? And this gives you time to kind of stop reacting, because anxiety is all about just reacting. You're not really making choices. You're not thinking straight. You're just reacting to stimulus that is hitting you, which is like bad news, bad news, bad news. So you're like, sell, sell, sell. I got to do something. And I know in life, a lot of times when we're in a bad situation, the answer is figure out what to do. But when a stock market collapse happens, it's usually nothing is the best answer. So besides uncorrelated assets, well, hold on, let's not move on from there just yet. Let's break down what an uncorrelated asset could actually be. So it could be something like precious minerals, like gold, like silver, right? Over the long run, investing in something like gold is 100% of your portfolio, you are likely going to lose to the stock market. Why? Well, because gold is just a rock. There's uncorrelated assets such as cryptocurrency, but I'm starting to kind of pull back from cryptocurrency as an uncorrelated asset, because we're kind of seeing when stocks go up, so does cryptocurrency. When stocks go down, so does cryptocurrency, and vice versa. Not truly the case, but there is a strong correlation. I think it's like at least over 75%. Don't quote me on that. But it is rather high that when stocks go down, so does crypto. When stocks go up, so does crypto. Not all the time. I think we did have in September of 2021, if you're watching this in September, crypto had a very strong pullback, and stocks did not currently have a strong pullback. So another thing that you can do to protect your portfolio is be investing in non-cyclical stocks. So non-cyclical stocks is something that is booming year round, and well, rather than booming, it's actually just bringing in enough business to sustain what it needs to sustain. So a company like, for example, Costco or Wallmart or even Amazon, for the most part, they're a year-round type of institution that profits. Like, it doesn't need to wait for something to happen in the market, right? Like restaurants, for example, if there's a recession, they're not going to be doing well. But Costco and Walmart, they're going to be doing okay whether there's a recession or not. So having those types of stocks in your portfolio could be a very defensive move, yet it's not completely defensive. Those stocks can skyrocket. We know that no company in the whole entire world has brought in as much money as Walmart did. So you could have a very aggressive move playing defensively at the same time by investing in non-cyclical stocks. Another strategy that you could use is build up your cash. Build up your cash position. Casper the Friendly Ghost. I gotta practice before I film a YouTube video. Casper the Friendly Ghost. Your cash positions. But this isn't your ordinary cash position. This is your opportunity fund. So for example, if you already have your emergency fund set aside, maybe you have 5 months of emergency expenses set aside. Well, if there's a stock market crash, you might sell off 3 months of emergencies and invest that in the stock market, turning the back end of your emergency fund into an opportunity fund. I think that is a very cool move that you could be making. And I want to go back just 1 second to uncorrelated asset classes, just to give you guys some more ideas. And that is, and the reason why I'm doing this kind of scrambled is, well, one, I'm kind of scrambled, but two is because the stock market crash is going to be a scrambled event. You will not know what to do. And this is all about creating a strategy before that day happens, because the last thing you want to be doing when there's a stock market crash and you have like maybe 10 minutes to decide before the next circuit breaker hits is you don't want to be making choices. You don't want to be making decisions. You want to already know what you're going to be doing. That's how you offset your anxiety. You have a predetermined plan. So my plan is to buy stocks that crashed a little bit harder than the stock market, the general stock market. And if I don't see any that I recognize that are brand names that I'm familiar with, that maybe products that I use of, I'm going to simply buy the U.S. index fund when the stock market crashes. But there are other positions that you could be purchasing to kind of prevent your portfolio rocking down just as hard. And like I said, there's uncorrelated assets, there's non-cyclical stocks, but there's also ETFs exposed to sectors that have not been performing super well. And one of those sectors is the value stocks. So value stocks isn't a true sector, but it is companies that they have people do an intrinsic calculation of what value means when it comes to investing. Warren Buffett, student of Benjamin Graham, one of the most famous and popular value investors, where he simply does not buy stocks based on their price. He buys them based on their inherent value. And even something like inherent value, even though everyone will swear that they have a system that truly calculates inherent value, there is still a lot of subjectivity to truly determining a value like that. For example, many people think that Alibaba is inherently undervalued, while people like Cathie Woods, who's a very popular fund manager, believes that it does not matter if Alibaba's undervalued or not because of tensions in China and Chinese government regulations. Alibaba is a red flag to have in your portfolio. So different types of mentalities, but one ticker symbol that you could be looking at is VOOV, which is an ETF that tracks value stocks. Now, the last thing I want you guys to consider is the average length of a stock market crash, and it depends how you define a stock market crash, whether it's 25%, whether it's 20%. I do 20% from the peak of stock prices when they go down by a fifth. To me, that is a stock market crash. The average crash lasts about 11 months, give or take a month or two here and there. But 11 months is not a long time to wait unless you have a short-term financial goal. In that case, oof, you better have thought before the stock market crashed. You can't just put in your money into the stock market hoping for the best and pulling it out in 2 months. That's not how this thing works. You put it in and you hope for the best for the next 2 decades, right? This is a long-term thing. A lot of people abuse the stock market for short-term returns, but that's not to say that there isn't a way to invest in the stock market for the short term, although I would say that the word investing and short term is an oxymoron. You're more trading, you're more trying to flip things, you're more trying to secure profit. In that case, I would say there are better places to do that than the stock market if you are working with a few $1,000s. For example, you could go to Marshall's and be flipping shoes or something like that. But when it comes to the stock market and you have a few $1,000s, flipping is pretty difficult, because to get significant returns, like if you have $2,000, to get $200, you would need 10% returns. That's about a year's worth when it comes to an index fund, right? So it's pretty tough to flip, but it is possible, especially if you do options trading. But there is a lot of risk involved in options trading. I would much rather prefer, if I have something like $5,000 or less dollars to work with, I would much rather prefer flipping items that are tangible, anything that you become an expert in, from paint to Pokemon cards to lumber to whatever it is that you feel comfortable with. Shoes is a very, very big one. People love shoes, whether stocks are up or down. People are always buying shoes. So with that, I want you to consider one more fun fact, and that is when the stock market crashes, there is a lot of opportunity. And even if we look at something like the Great Depression, where stocks fell 80%, I think it was like 84%, there's still a lot of opportunity there, because in the early 30s, there were months that are forgotten in history that stocks went up actually 50%, right? Imagine that. For in 1 month, you get 50% returns. That is the power of investing during a market crash. And of course, I will always advocate for dollar cost averaging for the typical person. So that dollar cost averaging is when you have a certain amount of money and you just put it into stocks gradually every single month or week or day even, right? I wouldn't go with a day. You'd be logging in and looking and get way too emotionally attached. And emotions are not a bad thing when it comes to the stock market, but reacting to emotions is. You never want to be a reactor. That exactly is the problem with most investors. They're reactionary. You want to be strategic. You don't want to use tactics. You want to use strategy. You don't want to pivot to the situation. You want to have a battle plan ready for every single situation instead, beforehand, right? It's the art of war. Most wars are won before they are fought, because the better strategy is more likely to win. Now, there are environmental changes. Of course, you can have a storm in the middle of, your forces marching out, and all of a sudden you're in the middle of the ocean and your ship is sinking and you're taking down everyone with you. And that is a full metaphorical circle for how we started this discussion. So if you enjoyed this video, drop a like, drop a comment with your thoughts. Do you think the stock market is going to crash within the next few months, within the next 5 years, or will the next big crash happen in a decade? And if we do have a crash, is it going to be a V-shaped crash, kind of like COVID, where the ship sank real quick and then everything came right back up? Or is it going to be more of a kind of parabola, if you will, right? Or a baby, right? Is it going to be a baby type of crash where it's going to take a while for this thing to recover all the way? Because, man, when babies have trouble, it usually takes hours to get them back. And with that, I am out. I'll see you guys next time.